Hey everyone, thanks for watching. We're coming to you from Fool Global Headquarters in Alexandria, Virginia. I'm Chris L., joined by Andy Cross, Abby Mallon, Senior Analyst. Thanks for being here.
Hey, Chris.
We're going to be talking about how to manage a portfolio, whether it's $1 million or less. I don't have $1 million, but these two know something about managing $1 million. We're also going to be taking your questions on stocks, so go ahead and get those ready. Type them into the chat box. And if you're looking for more detail in written form, go to fool.com/start. That's our investing starter kit. It comes complete with 5 starter stocks. A lot of great information in there. You can find it at fool.com/start. Andy, let me start with you, because whether you're managing $1 million or just starting out with a few $100s, there really are some great parallels for ordinary investors like me who don't have the $1 million. You both work on a couple of real money portfolios here at the Motley Fool. Let's talk about the partnership portfolio, which you all helped launch last year with $1 million.
Yeah, so historically we've kind of thought about portfolios and investing in our services as either kind of monthly rhythm of stocks. You have some money to invest, put that money to work. That's a great way to do that. I do that with my 401k, for example. But for the partnership portfolio that Tom created and Abby and I helped work on and help shape that, we started with $1 million, and then we decided to set a plan up, which I think is very important when you're thinking about allocation. And we set that up in 3 allocation tranches. We did the first batch, we invested 20% of that, or so $200,000 of that $1 million. The second one, about 6 months later, we did another $300,000. And then the last one, a year later, we did $500,000 and set aside a little bit in cash. So we set the plan out. We said we want to do these in 3 installments, and then we allocated the money accordingly. And now that $1 million is just shy of $1.2 million with $100,000, $165,000 in cash. The portfolio has done very well. It's up 45% versus the S&P of about 17%. Now it's only 18 months or so, so it's still very early. But I like how we allocated that in those groupings.
It's interesting because I've heard people talk about that type of allocation getting into a single stock, just thinking in terms of like, I'm just going to buy it in thirds. Abby, let me ask you, how did you and Andy and Tom Gardner think about allocation? Because I think when some people look at a portfolio, they're looking to build it. One of the ways to think of it is just in terms of market size, so small caps versus large caps. Some people think in terms of risks, maybe balancing growth stocks with some of those big blue chip dividend aristocrats.
Right. So for this portfolio, our strategy was really focused on founder-led companies. So we were looking for companies that had founders in CEO roles or various leadership roles at the company. So that was sort of our first filtering criteria. From there, this portfolio specifically, the strategy is definitely geared a little bit more towards growth stocks. So companies that have top line growth of about 15% annually was really the goal. So this will be a little bit more of a risky portfolio, which again gets back to sort of that strategic buy in thirds pattern that we executed here.
The one thing I like about the way we built this is that the first round we basically equal weighted across 25 stocks. And then, which I think is a very healthy way to get started, and it's a good way just to build out a position in stocks. Whether you have $1 million or $200,000 or $10,000, and you're looking to start investing in a few stocks equal weighted. And then as we got to know the businesses more and we maybe added a few in there, then we started getting a little bit more tactical and strategic with the allocations, a little bit more to this one that we like better, a little less to this, or sometimes not at all, and depending if we were adding stocks or not. So starting with that equal weighted, and then as we are getting to know the businesses a little bit more, adding to the positions that we liked and had more confidence in, because really it's a few of your stocks over your lifetime, and we were investing for at least 10 years when we think about this portfolio, really in all of our services at the Fool. Somewhere in the 10-20% of your stocks are going to drive the bulk of your return. So getting the allocations and getting the capital into those ones that you have the most confidence in that will then do well, I think is an important strategy to take.
That equal weighting, is that a good way for someone who's new to investing to start out? Because I'm thinking about 2 things. One, someone who's just starting investing, maybe they've got $1,000 and they're looking at a universe of 10, 20 stocks. I mean, one way to go is to essentially pick the 10 you feel the most strongly about and just sort of allocate $1,000 to each. The other thing I'm thinking about is the news recently, and this is good news for individual investors like us. TD Ameritrade, Schwab, E-Trade, all these brokers basically saying we're cutting our trading commissions to 0. So it seems like for individual investors like us, executing that type of strategy is even more attractive now because you're not paying a fee.
Yeah.
Well, the goal is to get diversified, right? So you want to make sure that you don't have too much capital in just one or two stocks, because that leads to outsized risk from one or two companies, and it can be very hard to stomach in bad times, and also very rewarding and tempting to make bad decisions in good times. So buying across 10 stocks sort of gives you a little bit of ballast to your portfolio. And I think to your point too, like now that everyone has access, or a lot of people have access to free trading, I think that should only lead to better outcomes. We tend to think around the table that, market timing is not what we do, and it's not our goal ever. It's better to be invested now and don't try and save pennies here and there, but keeping a little bit of cash opportunistically is not necessarily a bad idea.
I also say, Chris, that if you are really just starting out, like an index fund is a great way to start. If you have a couple $100 you want to get started,
yes.
A lot of my retirement money is actually just in the S&P 500 index fund, so just kind of putting it in there and it just automatically goes in. So don't be afraid to get started there, and then you can kind of add the stocks in, because that way you get a lot of diversification. Right. Abby's absolutely right. We want you building out 15, 20 more stocks. But if you really are just starting out, an index fund is actually a good one to go with too.
We're going to get to a couple of stock ideas in just a minute, but first, Andy, I want to go back to something Abby mentioned in terms of researching companies. Obviously, with the partnership portfolio, you're looking at founder-led companies. What are a couple of other sort of key areas of research that people should be doing when they're thinking about building out a portfolio?
Well, so there's lots of different ways to think about this. Most of the Motley Fools, when you look at our history of performance, so much of it is driven by information technology, consumer discretionary, so consumer-facing companies that we just feel we know so well. You don't find a lot of utilities and even real estate investment trusts in our universe. So we're investing in businesses that we think have a very good shot at beating the market over very long periods of time. And that really gets back to, Abby mentioned the founder-led story. I'll say a little bit on the growth side. She mentioned 15% annualized growth. Trying to find companies that can grow both sales and earnings and cash flow over long periods of time and have the ability to be able to continue to repeat that growth time and time again. If you can find those, have the discipline to buy into them and hold them for many years, that's a great way to think about building out a portfolio for the long time, and not thinking, Abby mentioned the trading, that's not what we're trying to do here. We really want you finding businesses that can grow both sales and profits for very long periods of time.
At some point, though, the question of when to sell does come in. Sometimes it's to fund new purchases in your portfolio. Sometimes it's the thesis is broken. Abby, when do you think about selling a stock?
I think anytime a position sort of gets uncomfortable, so that could be, maybe it's 10% or more of your portfolio. Perhaps that's your sort of temperament and you're like, above that I'm not really sleeping well. That's a time to sell, right? In this portfolio, or in the partnership portfolio specifically, we actually have sold one stock, and that was because the founder story no longer held up to what we initially thought it was. So again, strategy, having a clear thesis, making sure that you're tracking yourself against your thesis is really helpful to maintaining sell targets.
Let's talk about buying stocks, because once you make that initial allocation, Andy, and you've bought some stocks, and in the partnership portfolio, you left a little cash on the sidelines. Mm-hmm. But let's face it, sometimes we get a windfall, we have a few $100 extra bucks, we put it into our account. How do you think about new buys? Because one way to do it is just to look at your existing stocks, and if you've been going for a while, some of them are performing better than others. Maybe you feel even more strongly about them. But some people, a lot of people, and this is something we recommend at the Motley Fool, like to keep a watch list.
Sure.
So how do you decide where to put your new money?
Yeah, I think it was Peter Lynch who said the best stock you may want to buy is actually in your portfolio already. So don't be afraid to continue to allocate to some of your favorite businesses and build up those positions, because you think about allocating dollars into your favorite businesses, and if those businesses do well, obviously your portfolio is going to do better. Now, of course, the downside of that is if they don't do well, then their portfolio takes a hit. So don't be afraid to look at your existing portfolio and build out your positions. Chris, you mentioned buying in thirds. I think Abby, you said the same thing. So that's a good way to think about it. I think having a watch list, though, is a great way to think about adding new stocks to your portfolio if you want to add a little bit more diversification. Even if you just want to add more stocks and build out that portfolio of 20, 30, 40 stocks, don't be afraid to add more stocks to your portfolio. It also allows you to learn about more businesses, and that's just fun for us us as investors and analysts to really be on a journey of learning about businesses and investing. The more businesses you look at and have confidence in and learn about the times to buy them and the times maybe not to buy them, you're going to be a better investor for that. So don't be afraid to add on some of those new stocks as long as you feel comfortable in their market beating potential over time.
Yeah, I mean, I guess I would just add the thing that you want to keep in mind is, you want to give every stock in your portfolio an opportunity to sort of impact the portfolio, right? So when you are adding new stocks, or if you are adding new stocks, make sure that you're keeping that position size at a level that makes it so that it could possibly have an impact, right? And so whether that's buying a new stock at 1%, every time you put in another 1% on a dollar basis actually goes up, right? So being conscious of things like that. And then on the flip side of that, sort of, if you're not buying an existing stock, you're diluting every existing position you do have. So just managing position sizes relative to the other ones in the portfolio can be important.
All right, we're going to get to your questions in just a moment, but as promised, a couple of stocks for your watch list if you're interested. Andy Cross, let me start with you. What's something that's caught your attention lately?
Well, one that I followed for a while, and we actually own in the partnership portfolio, is EPAM Systems. The symbol is EPAM, and it's a software engineering and digital consulting firm. It was founded by Arkady Dobkin back in the early 90s. He was from Belarus, an engineer, and came over to the United States, and he's still a CEO and still owns 3% of the business. And he leverages and uses a lot of global programming talent to provide essential consulting services to companies ranging from pharmaceuticals to financial big institutional banks, healthcare, media companies, to help them basically improve their digital landscape. So it's a consulting firm. It's grown organic sales more than 20% for 30-some quarters, and it's very profitable, good returns on capital, and it has a long runway of growth. $10 billion market cap, so it's a mid cap, but still plenty of room to grow and a very nice balance sheet.
Abby, what about you?
Yeah, I was going to talk about health equity. So I think it's no secret that the U.S. healthcare market is really flawed. And actually, when you look at statistics, about 2/3 of all bankruptcy filings are related to medical expenses. So it sort of explains why healthcare, or part of the reason healthcare is such a hotly debated topic right now. And health equity really strives to help tackle that issue. So they are a leader and innovator in the high growth industry of health savings accounts. So this is a tax advantage savings account that's specifically for current or future healthcare expenses. And again, this is also actually in the partnership portfolio where we looked a lot at the founder story. And so this company was founded by Stephen Nealman, who is a practicing surgeon in Utah. And in the early 2000s, he saw this medical billing problem coming up repeatedly. So he actually was one of the initial people that came to DC to sort of try and find this solution. And he founded Health Equity in 2002. And in 2006, they became the first legal trustee for HSAs in the US. And today they have about 4.9 million HSA members and more than 10.1 billion in custodial assets. It's about a $4 billion company. So HSAs are still in an early stage of adoption, so there's a super long growth run right here. They're growing faster than the market. They're taking a lot of market share, and I think it's a really promising story to watch.
Interesting. They just made a pretty significant acquisition too. That's going to bring a lot more members into their platform, and there's a lot of scale in that business. So you add more members, very profitable already, and over time that can just make that business more and more robust.
All right, keep the questions coming. We're going to start them in just a second. And hey, if you like the video, please consider giving us a thumbs up. It helps other people find the work that we're doing here at The Motley Fool. All right, let's get to some of the great questions that are coming in. First from Louise, who asks, is it okay to own a lot of stocks in the same sector? I know diversification is important, but what if I don't know a lot about banks or oil companies? Great question.
It is a good question. Abby, you want to?
Yeah, I mean, I think an easy way to tackle that can be using ETFs or sort of index funds of some sort. It's very quick diversification, and it sort of allows you that ballast that we were talking about, which is the goal of diversification, without having to sort of go through and maybe analyze things you're not necessarily familiar or comfortable with.
Yeah, I think that's actually a really good point. Thank you for mentioning that. Because if you, as Abby said, the goal is diversification. So if you are, we're very, in the partnership portfolio, we're very tech and consumer facing. So stocks are really correlated in general so much these days, but inside the sectors, they're even more correlated. So you will see more drawdowns in tough markets for those stocks, and consequentially, you'll see the rises as too. But you will see the volatility if you are a little too concentrated into sectors.
Question from Jerry, who asks, as a recently retired investor, do you have some advice for income preservation, but also some growth? I like that. It's a little bit of Jerry wanting his cake and eating it too. And who can blame him?
Yeah, not at all. I mean, there's big advocates, and we actually did a YouTube live special on dividends, and dividend growth really is a place to a little bit of have your cake and eat it too. The yields these days on those dividend stocks are just they're not very high, especially on dividend growers, but you hopefully get some stock appreciation there as well too. So you can get a little bit of dividend, and if you own it in a tax advantage account, then you have some tax benefits there as well too. So dividends can be a good place to go. Be careful of chasing the really high yielders, because often that's a warning sign.
Mason asks, what types of stocks are good for low growth or recession environment? Increasingly, we're hearing the R word on financial television, all across the business media. I just think back to the Great Recession 2008, 2009. The one area that really seemed to do well, at least in terms of consumer spending, was pets. People were cutting back on their own expenses, Abby, but they were still spending money on their pets.
Yeah, I mean, I think it's an interesting question. I think putting it in context, I think, we've been talking about recessions or pullbacks or drawdowns, however you want to call it. I feel like it's been almost 2.5, maybe 3 years now. And if you had stayed out of the market in that time, you would be a very, very sorry investor. So I never would encourage someone to manage a portfolio specifically based on a market timing event like that. With that being said, there are going to be companies that are naturally a little bit more defensive to events like that. So one area that I think maybe to avoid if you're a little bit more hesitant or maybe scale back would be, we have a lot of companies right now in the market that are just not profitable quite yet, and that path to profitability relies on a lot of growth metrics, and it's sort of a flywheel, and so in good times it works very well. If that flywheel starts to slow down, you're going to see a little bit of tension, particularly within that software as a service, which is SaaS companies as we call them. That's going to be one segment that's going to be hurting significantly at the high valuations they're trading at today.
From the allocation perspective, we've also been using cash. I think Abby mentioned a little bit earlier, cash as a way to kind of offset a little bit maybe of the volatile, rocky times. It's not a panacea, so don't expect that. But maybe if you feel a little sensitive to the market conditions, building up a little bit of a cash cushion in your portfolio, not just to take advantage of prices down the road, but also maybe help manage a little bit of your temperament during those times.
That's a great point, Abby, about context mattering. And you're right, we've absolutely heard a drumbeat about recession for a couple of years now. One thing I do think that's different, though, and this sort of plays into something you were talking about, is you think about the IPOs we've had in 2019. A lot of companies, some of them big and splashy, brand names that you know. And if they're not profitable, we really see the leash that's being given these stocks get shorter and shorter. So to your point, I think that's where it gets a little tricky for the unprofitable growth companies.
Certainly. I mean, I've spent a lot of time looking at the IPO market, and another interesting point just to recessions, IPOs, things like that. Hot IPO markets tend to be a forewarning for very stagnant market conditions. So companies tend to go public at peak market valuations, which makes sense. And then immediately following sort of a flood to the market, there's sort of a lull period within. So we are at an outsized level based on average number of companies that tend to go public. We're also reaching new highs of valuations for companies that are coming public. So it's something to keep in mind.
Did Abby just make a recession call? That's what that sounded like.
I'm saying we're on the up pattern, which tends to be followed by a down pattern.
The valuations have come down a little bit, but to her point, the valuations were pretty elevated.
William asks, should I be nervous about Chinese stocks? This is another dominant story that we've heard throughout 2019, the trade war with China. We have the most recent retail sales report from September, and you hear some comments from major retailers about, yeah, it is starting to have a little bit of an effect. And Chinese stocks, even just the risk of potential delisting, I think for at least some investors, and maybe William's one of them, this moves Chinese companies down the list a little bit.
Well, it might. I think, like any business, I mean, investing in stocks is certainly not risk-free, and there's risk to all businesses, a lot of headline risk around those, and you don't have to own those businesses. There are plenty of great businesses that are focused and domiciled and spend most of their businesses, their customer base in the United States or globally, that's fine. But yeah, like if those concerns are worried about your Chinese stocks, you don't have to hold those. You plenty of opportunity here. Generally, understanding that you are investing in these businesses for the next 5-10 years, that's a perspective that if you take, it does tend to help neutralize some of the headlines that you hear and some of those risks. But still, if you can't, if emotionally you can't, that's just not your cup of tea, then you don't have to drink it.
Yeah, I mean, I would just add, I think, when people started getting excited about China, which happened, 10 years ago, the idea was really that the population was growing at outsized rates. They had a blooming middle class, there was all these sort of economic impetus that would make this a very, very profitable market. And I think none of those have really changed. So fundamentally speaking, in the long term, again, as Andy was saying, like 10 years down the road, it's still going to be a potentially very lucrative market. It's just in the short term, you're going to see some political volatility.
Ed asks, what about buying gold?
Ed is not, speaking of cup of tea, that is one tea that I will not taste, and I don't own. I mean, in general, gold is it's a fear-mongering investment, and people own it as some kind of reserve, but it has no economic benefit. It doesn't pay you dividends. It just goes up or down. Tends mostly to go up and down based on macro concerns. The debt levels out there that the governments around the world are accumulating, even with the low cost of debt, there are some concerns around that, but long-term GDP growth continues to steam ahead. So even though it's a little bit slower in certain parts of the country, but overall, we're not a fan of recommending and buying gold assets.
Michael asks, would you recommend REITs in retirement? For those unfamiliar, REITs, real estate investment trusts, a bunch of different ways to invest in real estate. REITs is definitely one of them.
I think REITs have a place in every portfolio. It just depends on your expectations and your outlook. So I think for retirement, they can be very lucrative or it can be very risky, and it's really about the specific REIT you're talking about and how you're investing in it.
We have a few people who have been asking about investing in the cannabis industry. Thoughts in general, but also a couple of people asking like, hey, is this starting to rally? I mean, marijuana was a really hot investment a year or so ago, depending on the company. I mean, we were talking before about some of these unprofitable growth companies pulling back. We've certainly seen that in the cannabis industry as well.
So many of these companies or industries and sectors that get a lot of attention, whether it's IPOs, cannabis, it can be almost anything, get a lot of attention. So much money goes into it. It makes it very difficult for long-term returns as a sector. Now, especially as you're thinking about the short-term returns. But now long-term, when you're thinking about some of these businesses, there are opportunities in there, like there are in any sectors, to be able to make some money, and there's certainly a market, and this market is evolving and changing every day. The cannabis market, both in Canada and in the United States, so there's definitely a growth tailwind behind it. I just think so much money got pumped into the sector with so much excitement, and so much of that tends to be short-term and much more volatile that some of those stocks have just struggled recently. But long-term, there's going to be some winners out of that industry for sure.
Yeah, I think one thing to keep in mind is that cannabis as a substance is more or less a commodity, right? And so those industries or those businesses tend to be sort of less attractive for long-term outperformance. But if you think about the tailwinds and what's going into that industry, and maybe sort of tangential businesses that have a little bit of exposure and a little bit of benefit, but not fully focused on growing cannabis, might be a little bit more attractive.
Susan asks, is there a point where it's good to sell a stock that's gone on a big run, and then adds parenthetically, for me it's Netflix, because it is too much of your portfolio? Great question. Netflix, and by the way, that's the proverbial good problem to have, right?
Yeah.
What do I do with this stock that's gone up so much? It's an enormous part of my portfolio. Netflix up again earlier this morning because of their latest quarter, some good international growth numbers. But to Susan's question, what do you think about selling when it really does become a big part of your portfolio, Abby?
I think I mentioned this earlier, but anything that sort of gets uncomfortable, I would recommend trimming back. I don't think necessarily cashing out entirely unless you really see an issue with the business or the thesis. So I don't think it's a bad idea if you're thinking about it. I would just make sure that wherever you're reallocating those funds feels like it has a better opportunity, whatever your strategy is, whether it's growth or income preservation, dividends, just making sure that you have a plan for it.
Just real quickly, I'm just curious, for each one of us, what is that percentage for you? Because you mentioned, and it's true, for some people it's, if this gets to be 10% or higher in my portfolio, I'm trimming it back. What is that number for you in your portfolio where you look at a stock, it's run up so much that you think to yourself, no, this is too high for me personally?
I think it would have to be company by company specific, but 10% would be I start thinking about it, and 15% is probably like, I have to do something.
Andy?
Yeah, I would, Home Depot and Berkshire Hathaway are two of my largest positions, and I feel very good about those long term. So I'm more in the 15%. I start to be like, okay, do I want to own those businesses? And anything gets in the 20-25%, I would probably start thinking about paring back a little bit. But Abby is absolutely right. It's really company by company, and whether you can stomach if those stocks get a wallop at one point, or the recession hits and the market pulls back, because some of those stocks will hit, and that will hit your portfolio.
Joel asks, what are your thoughts on ESG stocks? It seems like they can help you do well and do good at the same time.
Yeah, I mean, I think we think about ESG, for those who aren't familiar, ESG stands for environmental social governance. So they're companies that, well, every company can go through an ESG framework, but companies that are considered ESG friendly sort of meet these requirements for being beneficial to the world and all stakeholders. And I think it's a very attractive and interesting market segment. I've read conflicting reports about whether or not it does outperform the overall market. And I think it's really a personal call, but I think it's an admirable strategy to take.
Well, and it definitely goes to, particularly the governance part of that is something that every investor should pay attention to,
right,
no matter what companies you own, because
absolutely,
at the end of the day, it's human beings running these companies, Andy, and we want to make sure that they're running them in an upfront manner.
Yeah, we talk a lot about culture and trying to find management teams and boardrooms that are aligned with the investor, have the same principles that you do, and building a portfolio of businesses that you feel very comfortable owning and feel good about, whether it's governance or what industry they're in, how they treat all their stakeholders. Abby mentioned employees, customers, their shareholders as well. So that framework, it is important to focus on and understand who is running the business, because ultimately it is the people who are going to allocate the capital that's going to generate a higher return for you or not.
Last question before we wrap up. Daniel asks, how often would you recommend adding to a regular brokerage account after the initial investment, and how much money in percentage terms would you recommend? Great question, because on the one hand, we're not looking to do a lot of frequent trading.
Right.
On the other hand, adding on a regular basis really is going to set you up well for the long term, particularly if you've got that 20, 30-year time horizon that we like to see.
Yeah. Abby, do you have any thoughts?
Well, I guess my answer would be, if you can add, do, right? We would never say, it depends on what your circumstances are and where, if you're not putting your money in your brokerage account, where it's going necessarily. But on average, you can expect the market to return about 7% annually. Those numbers obviously go up and down, but keeping that in mind, you want to be opportunistic. You want to set yourself up for the best pathway forward. So if you can add, I always say you might as well, right? And so get invested maybe on a monthly basis as sort of our stock advisor, which is sort of our entry level stock picking service, is a monthly investment.
Yeah, the idea of saving and investing, and the beauty of compounding returns, Chris, as you know, when you just look at those returns over time, having the money in the market and accessible. So definitely encourage you to continue to try to invest a monthly basis, a little bit from a paycheck. For my kids' accounts, my daughters, I just put a little bit of money into their accounts. Sometimes I invest it into stocks, or sometimes it just sits in cash. But that discipline of kind of like setting aside and doing that is really healthy. And then thinking about how you want to allocate that into stocks or index funds, I think is a really good approach to take for any investor.
If you're looking for more information, you can go to fool.com/start. You can get our free investing starter kit. It comes a lot of great information, including 5 stock ideas. So check that out when you get a chance. And again, thanks for giving us the thumbs up and liking the video. We'll keep them coming every week. Abby Mallon, Andy Cross, thanks so much for being here.
Yeah, thanks, Chris.
Thanks.
Thanks everyone for watching. We'll see you next time, and Fool on.